the stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good. Huge upside potential, upwards of $60,000.
Ms. Patel, do you know what a fugazi is?
Yeah, it's basically like fake. Like if you're trying to make a deal. Yeah, if you're trying to do like a deal or something, it's like a fake thing. Yeah. It's fake.
It's a joke. It's a joke, my guy. Anyway, it's so literal. Man, port strike is over. That was like the most short-lived of all time. What did you think about all that?
This is horrible, bro. This is really bad.
Why is it horrible? What do you mean? Toilet paper? No, is that
no. Okay, so here's the thing. These guys at the ports, they were smart. They leveraged the election. They leveraged inflation. They leveraged the power that they had with causing mass disruption, and they got what they wanted within 72 hours. So the problem is this:
the 60% increase, or
well, no. It's one is the 60% increase. That's crazy, but at the same time, every single union boss in this country right now is going to look to replicate a very, very similar outcome. Okay. And if they're not, the union members are going to put someone in charge who will try to replicate a similar thing. So they were very smart and they were very strategic. They pointed out the inflation picture, which no one can deny, because we did have, a bout of high inflation. But now they've been able to win wages that are going to far exceed the current level of wage growth, at least temporarily. So the thing is, yes, it's good that these individuals won their pay raises and their benefit increases, but they've also basically just announced to the rest of the country and to every other union out there that the vulnerability of the mass disruptions is actually very real. Yeah. Now, the question is, how many can actually take advantage of that prior to the election? I don't know. I can't really say. But this is one of those times where we have to kind of factor this into our calculations when it comes to investing and figure out, like, okay, is this the moment where the level of inflation is now going to be entrenched at a certain growth rate for wage inflation? And then what happens is, if they see, what ends up happening is, if they got it, then we'll get it. And then if we'll get it, then they'll get it, and they'll get it, and that guy will get it. So every single person is going to be demanding more in terms of compensation and wages, especially if you're in a critical role, depending on, what position you have. But so even though I like the fact that, workers are getting paid more, I know that the ramifications of this could be more of a problem. And this is the issue that we had with regards to inflation. Remember when I think the Fed kept mentioning it, that like they really don't want inflation to become sticky, Yeah. So I am part of Rob is asking, are you part of a union? I am part of a union. That is true. The thing is, though, my union raises weren't nearly as generous as these guys are getting. But it's fine. I mean, it's, it is what it is. But it's one of those things that's, it's gonna, like I said, the consequences of this are not going to be felt right now. It's going to be something that's going to be more felt over the next 5 years, because like I said, every single person now is going to see this as an opportunity to basically leverage their positions to get more. So a 62% pay increase over 6 years, it's significant amount of money. And especially if you look at how much the longshoremen already make, it's going to be significant amount of money that they end up getting. But the money is not the issue. It's really not. The bigger issue is a combination of weakness on part of the government to kind of not control inflation sooner, so that things like this became a lot more justifiable. You know what I mean? Like right now, I haven't got, my wages are not going up by nearly as much as that. I mean, I don't know about you. You work in the private sector. I'm not sure if it even gets close to that.
Yeah. Yeah, I mean, 62%. It's pretty impressive. I mean, it would take me to get several job promotions to get something like that, right? But I think the thing that didn't really hit home for me, the first initial thing I thought was I was listening. Everyone was talking about how bare the store shelves were. TP's out of stock. Everything everywhere.
It's because people are
People
stupid. Yeah.
Yeah, people were worried about bananas. People were worried about, people are buying up Home Depot lumber, stuff like that. So hopefully they're in a market where they can use it, and they will be using it. Let's just say, say you're at Home Depot. Hopefully you're like a carpenter, and you weren't stupid, and you just had excess money or lying around, and you're like, you know what? I'll buy a couple months ahead of time just in case, so I can keep going with my jobs and I'm not out of work. That's fine. But if you're like somebody that's literally sitting now on like piles of toilet paper and like a bunch of bananas or something like that, just for the sake of it, the joke is on you. But I think that there is something to be said about the inherent underlying force growth now within the food and just a lot of other sectors of having to now eat this 62% cost over the next 6 years. And you think about it, it's like that. I'm not good at the annualized numbers, but let's just say instead of 10%, so 10 times 6, it's probably going to get worse, but it's probably like 8 or 9% annualized over the next 6 years, if you look at it in that perspective. So when you're talking about inflation being 2% or aiming for 2%, that's just another headwind like you're talking about that immediately is going to be put into things. But anyway, other than that, I do want to touch on a lot of other things out there. We had the jobless numbers come out this morning, over $200,000 jobless numbers. Then the jobs report tomorrow, everyone's expecting between 140, 145,000, which is going to be about flat from August. Then there's obviously the fact that it's Red October, as some may call it, and historically a very volatile month. And even more so from what I understand in election years. I haven't done this due diligence. This is just what I've been hearing. Curious to hear your thoughts about any of those topics. Red October, the fact that it's more volatile in an election year, the jobless numbers this morning, coupled with the potential jobs report being flat from last month. But before you get and dive into that and choose your topic, I was listening to CNBC earlier, and one of the previous Fed analysts was basically saying, well, it doesn't really matter what number they come out with because they keep revising the number, 6 months down the road anyway. So it ends up looking worse and worse from an unemployment perspective. So even if they come out with 140 tomorrow, it might be revised upward in the next couple, or downward even in the next couple months. So,
Yeah.
do you want to choose any of those topics? Were you paying attention?
Oh, sorry. I was actually looking. I was looking at a data point. So I was like, oh, let me let you finish. I was just looking at this data point real quick. It's just
pull it up.
I wanted, this right here. Can you put the Sherpa thing down? So if you see this, inflation prior to this was growing at about 1.3%, and wages were actually outpacing inflation, which is good because that means on a real basis, people were getting compensated more, right? So a lot of this was under Donald Trump. I know a lot of people are going to say, oh, fuck Trump, blah, 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 all that stuff. Keep your political leanings to yourself, whatever you want to think. When it came to the policies, they actually were very helpful to the worker because at the end of the day, you put tariffs on China, more production had to be built here in America, and that started this wave of inflation because wages started to outpace inflation. The problem is when inflation started to go up, wages weren't catching up. Then we had a labor shortage, which meant wages started to go up, and now wages have kind of like moderated, but they're still not nowhere near levels that they were before. So in terms of like real wages, workers are getting paid way more right now. The problem is this is what's going to cause a lot of stickiness unless we get some sort of like a recessionary impact getting us hit. The other problem is this will likely result in a lot more income inequality, in that there are going to be certain jobs that if you get this job, you're going to have like this tremendous amount of buying power, and you're also going to get a tremendous amount of, leverage that people at the bottom may not exactly have. Like the worker at Waffle House does not have the same leverage as someone who's a longshoreman, yet the longshoremen are going to be making way more money, right? Now, the thing is, like, technically speaking, you for a healthy economy, you would want to have more market-based approaches. So when your service is, deemed to be high skill, high labor, then your wage goes up, and that forces more people to kind of go into that job category. Right now, you're creating a protective class of people and a protective industry, and now everyone else is going to have to just deal with it. And the thing is, no one is just going to deal with it. Everyone is going to be it's almost like this thing where everyone's boats are like, everyone's expectations of wages now going up are going to be a lot more, And the thing is, some of this was honestly like the fight for keeping the jobs, basically like limit the amount of automation. But honestly, I think this is probably going to supercharge automation. The companies will find ways to work around hiring more workers. And believe it or not, this is one of the tragedies of being in a union. And I am a part of a union, by the way. I have colleagues that basically they come to work and then they start working when the overtime starts to kick in. Okay. So what they'll do is they'll just like fiddle faddle, throughout the entire thing. And then when it's time to do overtime, it'll kick in. And the thing is, then they'll say, I'm overworked. Now, the thing is, the employer is like, okay, I want to hire more people, but I can't because I have to keep and I've been on both sides. I've been in management where basically they wanted to hire more employees, but the union said, no, you can't. You have to give these guys preference for overtime. So you can't hire temporary workers and all this other stuff. So what ends up happening is it really does set a really bad precedence of what's probably going to keep inflation higher for longer. And I think that this is probably a 3, maybe 4% inflation being somewhat more normalized. And so the Fed's moving target is not necessarily going to be reached of 2% unless we get some sort of crazy level of, innovation that drives cost of manufacturing, cost of goods and services down significantly, which AI could do. And then another thing is also what's that thing called? Energy. So if energy prices come down significantly, then we could also see that. But what we're seeing right now in the Middle East, that's another topic we need to probably talk about. You're going to end up causing, because of everything that's happening in the Middle East, we could end up seeing oil rise back to this, at least the high 80s, maybe the 90s again, if production gets cut, or if there's any tension in the Strait of Hormuz. So you're dealing with this very complicated beast that is inflation right now, and everything was going in the right direction. And then all of a sudden this month comes in and September just comes in and just throws every market prediction out the window.
Yeah. Well, I think the only benefit for oil prices, I'm still bearish, by the way, and I still think that I'm hoping that things get resolved well. I mean, this conflict's been kind of going on at an escalated rate for over a year, going on a year at this point. Next week coming up, it's literally a year. So my hope is that it gets resolved, but I think there is some short-term tensions. My hope is that it fizzles out eventually. One punch gets thrown, another punch gets thrown. Eventually, it sort of settles down again, kind of like it did a year ago. But I don't know, right? That geopolitical stuff, I'm not the best at understanding it, nor am I any sort of expert on what's going on in the region. So, but what I will say is I'm just surprised right now that oil is still below $75 a barrel with everything that's going on. You still have an ongoing war in Ukraine. You still have an ongoing a tension that's been going on in the Middle East and in Israel and Iran and many other nations and tribes for the past year, coupled with hurricanes going on in the Gulf of Mexico, OPEC curtailing a crap ton. So it's like, if you think about all these different things, it's surprising that oil hasn't been elevated more, right, with the disruptions. And so that continues to give that bearishness sentiment that I have, coupling with, and I think a lot of this hasn't gotten resolved yet. You still have a lot of facilities down in up from just the hurricane last week and potential for more hurricanes to come. So I feel like you really won't see it as hurricane season in the Gulf kind of comes to a close in the middle of the month. I anticipate you won't potentially see demand really start to fall off. I think there's also an offsetting piece with the stimulus in China that people are starting to get fired up about. So anyway, I'm curious. I hope people, I know some people are wishing against me with the oil trade thing, but I'm honestly just surprised we didn't see a bump up to $80 a barrel, knowing what's kind of going on in the world right now and the short-term volatility that might happen with the geopolitical tensions that are out there. So to me, the fact that you're still seeing under $75 a barrel West Texas Intermediate and 77 for Brent.
That's because there's
pretty impressive.
There's still a lot of production that's coming on back on. Like Libya is starting to increase their production again.
Yep.
The U.S. grew its production almost 6% this year. So, I mean, we are are we the largest oil producers on the planet right now?
Oh yeah, 100%.
Yeah. So I mean, OPEC, whatever leverage that they had 12 years ago, it's gone. Like right now, we can just turn the taps on and basically a lot of these oil companies, they've figured out capital structures where they can make $60, $70 oil work for them, which wasn't the case 10 years ago. 10 years ago, you needed 80, maybe 100 just to break even. Now with all the laterals and like the efficiency gains and also like the bankruptcies, which took out a lot of their debt, but they left the infrastructure. Because I know a lot of the ones that got folded into the super majors, their capital, like they have much better rates of return than they were before, so.
Yeah, they've also, a lot of them have paid down their debt to an extreme margin, so they don't have a lot of interest comparatively to what it was. Like the market was it was almost like what's the word I'm looking for? It was like a buyer's market back then where everybody and anybody was trying to get involved. And now it's almost like a seller's market where it's like, hey, prices can go down. We're suited for the long term. We're buying back stock. We've set ourselves up for $40 break even, $50 break even if you want to include the dividend. So in that respect, I think you're almost at a disadvantage now because the U.S. has grown so much. But at the same time, it's like you now literally have to use OPEC as the demand tap, right? Like as it goes up, as it goes down, it's really based on. That's the only reason why Saudi Arabia isn't the number one producer anymore, is literally because they're taking the brunt of all these cuts. So if you think about it in that perspective, they're just like, there's no incentive for us to increase to 20 million barrels a day because we're always going to have to curtailing. So it's an interesting impact. And but to that extent, at $73, $74 a barrel, I don't necessarily see that being a huge impact year over year on inflation, but it doesn't help. Like if you were to see it go to $60, $50 a barrel, that would be a tailwind for inflation coming down. But unfortunately now it's kind of this neutral thing that I was kind of hoping would kind of help in the next few months. And so you have this piece about oil prices kind of coming back up, trickling back up. Unemployment's, elevated above 4%. The revision numbers from jobless claims keep going the opposite direction, and jobs claims keep going the other direction. And so, you even have JPAL saying, well, 25 basis points is pretty much what's on the table. I think everything in this respect, like to me, looking forward for the rest of October, until we get a definitive answer of what's going on in November, I honestly see that there's not a lot of upside from here, and there's a lot more downside. And really, the only upside I could potentially see is if if oil continues to go down and help with the inflation number in a positive direction, meaning going closer to 2%. And also if Donnie comes back in, I think that there's a lot of hesitancy based off of what the Harris administration is potentially proposing. I don't necessarily know if they're going to continue to extend the Trump tax cuts. My anticipation is no. And so that has a lot of headwind against the consumer. If Donnie gets in the office, then he's going to help continue those Trump tax cuts, and he's actually talking about extending them. And he even cutting deeper, meaning a positive increment to everybody's wallet, that would help the consumer even more. Will it help the deficit? Probably not. So there's that piece associated with it. But you think about what's the next leg up other than artificial intelligence and the gains and performance gains and efficiencies associated with that, how that can positively impact the market. What's going to be the next leg up? And the only thing that I could personally see is tax cuts at the business level and at the personal level that could allow people to spend more. And also you can claim more net income on the bottom line. That would allow you to obviously throw a 10, 15x multiple on that. And that's what, the economy is going to raise by in the matter of a couple months. So that's really the only positives I see between now and the end of the year. And really, I think another piece that's really showed me towards swaying more towards the peak aspect of where we are recently. And I'm not to say we can't get to 5,800 on the SPY or anything like that, or the S&P, but I think that, it's more likely we're going to see going downward. I think it's this thought process that everybody we were going to get 50 basis point cuts in November and December. And now it seems like Powell is kind of saying, no, that's only really if things start to look really bad. So it's almost like you should anticipate 25. And so I think a lot of the gains associated with people anticipating rate cuts and everything like that, as we've seen with the 10-year, everybody anticipated it. And now it's actually started to go the opposite direction. So it's like all these gains that we were expecting with respect to, positive feeds back into the economy have already been realized with the 10-year cutting back to where it was. It's actually started to reverse a little bit, as you've seen. So it's like, we can't even expect, unless there's a greater cut, 50 basis points in November, December, we can't even anticipate any sort of tailwinds associated with that.
Yeah, I mean, this is right when you were talking about it. This is exactly what I was looking at. This rise in the 10-year is a telling sign of like where the bond market thinks we're likely headed when it comes to the inflation picture long term. I mean, this was clear as day. In my opinion, we could head to the 4s or maybe even the 5s maybe not the 5s. The 5s might be a little bit overdoing it, but we could definitely head to the 4, maybe the 450 mark. I know Jim Bianco at Bianco Research thinks that 4.5 is plausible. Yeah, I think if some data points that come out that really like shows that inflation is rather sticky, we could see that. And the thing that we need to be very careful is the market is projecting, in my opinion, a little bit too many rate cuts too fast. In which case, if the indication ends up that, hey, you know what, the economy is doing okay, and we're not going to get as many rate cuts, a lot of the businesses that have benefited from the projected rate cuts are going to scale back a little bit. And you can already see the valuations relative to the interest rates are really, really high right now. So yeah, there's just not, in my opinion, there's not a lot of opportunity in this market, or at least there's not a lot of screaming buys. Like you really have to dig down deep to find value right now. So I personally wouldn't mind to see a 20-30% correction, because you're only look, if you're an investor, you don't make money when markets go up. You make money when markets go down, because that is what gives you the opportunity to buy things that are heavily discounted, right? Like no one goes into like the store and say, oh my God, look, the prices are going up 5%. Let me buy now so that I can buy. No, it's usually when you're buying something at a discount, that's when you're going to make money. So right now, there's a lot of bullishness all over the place. I mean, AI, in my opinion, is starting to kind of become really, really frothy. Valuations on OpenAI are just absolutely crazy. NVIDIA started to climb up again. I mean, all the signs, I don't even know, like this Cerebras IPO is going to be another thing that's going to probably drag a lot of capital into that AI question again. So the thing is AI in a bubble? Probably. But unless we see some damning evidence that the bubble is finally popping, I think there's still room to go, So I as of right now, AI is still the trend. AI is working well for the people who are in it. Yeah, just, I don't know. I don't know how far.
No, I mean, I think you said it perfectly well. I mean, I don't expect to magically gain another, let me just think. I mean, I'm like 10% away from a number that I want to get to. Yeah. I think that that's going to be very tough to get there. I mean, to see another, let me just do some quick math. Yeah, to go up another 25% from here, I would be very surprised. Unless I have some stellar gains in Rocket Lab or Palantir or something like that, which, to be honest, Palantir's $40 a share almost basically at this point.
Look at this. I was gonna show that.
Yeah, like
that
it needs a pullback. Like it's out of control.
I think
So anyway.
this is retail euphoria on another level, dude. Like this is one of those times where retail has really over committed to this thing. And I know right now I'm gonna look like the dummy talking about it because it's like, oh, you were saying that Palantir is overvalued at 25. Now you're saying Palantir is overvalued at 39. You've been wrong before. And I'm like, bro, don't let recency bias become your mantra, because that's exactly how problems end up coming around in most people's portfolios, where they quit using logic and instead they use their success as a way to double down on their core belief. So did I think that Palantir was even going to get close to 39? Absolutely not. If you had told me, like, look, any reasonable investor can tell you right now, based on reasonable assumptions, this should not be possible. But then again, the market, if the market was always reasonable, you would never ever get the opportunity to basically make money, right?
Yeah.
Things can get unreasonable both to the upside and to the downside. Right now, in my opinion, Palantir's very unreasonable to the upside, which means that the likelihood is eventually, gravity is going to come down and it's going to bring it back down. But I can't tell you when that is, and it's really hard to predict what that's going to happen. I mean, most short sellers, when they go short on things, they're going either based on this hunch that the valuation may end up coming down, but more because they believe there's something nefarious at the company level that's fraud or something. Palantir is definitely not the latter. So the first one is the one that you would have to rely on for a short thesis. The problem is the second one is much easier in terms of like getting a correction. The first one is much harder. Like when people are absolutely just buying this thing up, you don't know where it's going to top out. So in terms of like shorting, I would not want to short Palantir like this. There is a way to short Palantir that I'm considering right now using some leverage options plays, but it's not something that I'm probably going to discuss publicly. And I may just keep it very private to myself. I'm not even going to discuss it with Patreon people because I don't want people to get into it because it is a risky proposition, but the total payoff would be huge. So in terms of like risk to reward is actually pretty good if you're willing to kind of, just be very, very mindful of how much you're willing to risk and everything else. So like whenever things like this happen, these are perfect opportunities to basically take some risk on and waiting for a pullback. The market is overvalued and Palantir is overvalued. Yeah. So, and sentiment is over. Insiders, including Teal, are selling off. That leads me to believe that they're front running something. But the thing is, you can't tell that to a bull right now. If you say, "Oh, Peter Thiel is selling because he thinks it's overvalued," they're gonna laugh at you and be like, "Ha ha ha! No, it's not." So you can't even reason when people are in euphoria mode. You can't reason with them. So I don't try to, and I just cool. No problem.
Yeah. So quick shout out to Austin for rejoining as a member. Much appreciated. All that money goes back into the public portfolio. But I do want to touch on Palantir because I'm in agreement with Chris here with respect to it being at $39 is effing insane, right? I mean, obviously my wallet is very happy. It's actually not my largest individual stock. That's Rocket Lab. So eat that, everybody. But that's a different story for a different day. But I agree with Chris here. I mean, you're seeing retail investors sell. You're seeing insiders sell. I think what ended up happening here, and the truth will pan out, let's just say, within the next 30 to 45 days. I think what ended up happening, you had a very positive second quarter. Coupling that with positive sentiment about getting included in the S&P 500, I think that caught a lot of people by surprise. But now that is now able to be kind of acted upon, I think you're seeing a lot of retail investors, institutional investors pile in. So I think you're seeing a lot of people that previously didn't want to invest in the company because it wasn't an S&P 500. including institutional investors. And then you're also seeing a lot of retail leave and a lot of like insiders sell teal, carp, etc. So somebody's buying the effing stock, right? So who is it? My thought process is it's institutional investors. So very much like what you saw with Tesla back when they got involved in the S&P 500, you're now getting everybody and their mom starting to buy Palantir because it's safe now. And I think you're eventually going to see at the point where they load up and they've got their exposure in the S&P 500 ETFs. They got their exposure in the defense ETFs or whomever needed to get into whatever ETF and put Palantir in it. And eventually when that stops and you continue to see selling from carp, you continue to see selling from teal. As an example, they're probably already sold as much as they're going to sell, but there's other people, retail, other insiders that have yet to really take their opportunity to sell. Once they see this start going in the opposite direction, let's just say 35, 34, 33, I think you're going to see people pile on and also sell. Not to say that you're going to automatically see it get out of the indices. Like that's obviously dependent upon the underlying underlying company performance, not the stock performance. So the fact that they're still going to be profitable doesn't necessarily mean that you're going to see them removed from the indices. But I think you had so many catalysts going in the right direction throughout the third quarter because of the second quarter results and everything else. I think a lot of it hinges on October 31st when earnings are. If you don't see a 30% plus ticker on the revenue growth, the top line revenue growth, this thing is going to fall like nobody's seen before. I'm not even trying to be mean. Like I think everyone just assumes that we saw 27% year-over-year revenue growth on Q2 on a weak Q2 from last year, by the way. And I think if you don't see a 30% plus on revenue growth, I want you guys to clip this and record it. You will see very bad numbers. I'm not saying it's going to miss, but I'm just saying if it does, dude, it's not going to be good for the stock. And I think that everybody and their mom right now thinks that this is going to be mid-30s% year-over-year growth in the third quarter. And we'll see. I don't know. I'm hesitant. I think everyone's assuming that what's going on with NVIDIA, what's going on with all these other AI companies and the fact that Palantir is kind of leading that charge. Everyone else is starting to realize that they actually do have some good AI products, which I've been touting for quite some time. It's just led all at one point to this point of it being undervalued, in my opinion, to now being extremely overvalued. And it needs to hit some sort of regression point where it kind of normalizes. So I anticipate it's going to pull back pretty drastically.
The one thing that keeps coming into my brain and it just keeps like, it's when this question was asked to Alex Karp, how much of this revenue is just pilots? And he couldn't give a straight answer. When I heard that part, that like really like set it off for me. I was like, okay, so is this reacceleration and growth that we're seeing just a whole bunch of pilots that have come online and basically, boosted up their revenue from a weak year-over-year number? So if that's the case, the expectations for reaccelerated growth are there. And then you have all these analysts constantly like throwing up higher and higher price targets. I think that's what's leading a lot of people to it's almost like lemmings, it's like one is being led by another. And it just, like I said, nothing good is going to come of this, but it's okay. I mean, this is where I'd say, look, it's not bad to be in this company, especially long-term. If you really like the mission, you like the stuff, but this is the perfect time to hedge, buy some puts, go to sleep well at night. And the thing is the puts, the one thing, Matt, that I've noticed, did you see the open interest on the puts on this thing?
No, but I know the covered calls are really starting to lose a lot of their premium, meaning that everyone on the covered call side is really starting to say, is this thing actually going to keep going to 45 or what? Versus everybody on the opposite side is starting to be like, okay, this is where the premium should be because it's more so likely to go down than it is up.
Yeah, I mean, at this point, if you look at the puts, I was thinking about, I was like, oh, you know what? I'm just gonna buy some just plain puts. And I was looking the pricing on those, and those are just nuts, for the amount of time I was looking at. So I'm looking at like mid 2026, because I usually do longer dated options on on stuff. So like June, right? Look at this on a $40 thing on a put, still like $9 on a $40. That means that it's like a move almost $30 break even. So no, man, the puts are expensive. And look at the open interest on these things. So, someone knows something. It's just it hasn't really worked out that well for people. But like I said, I have a strategy in mind that I'm probably gonna apply to this thing, and hopefully it works out well. And if it doesn't, I'll lose a little bit of money, but it's okay. That's the price of admissions that you have to pay for investing. So,
Yeah, I wasn't looking this far out. I mean, I was looking more short term. I mean, I wouldn't be surprised if these are still kind of far to break even. Like this is 30% on the call side to kind of break even, which kind of makes sense, right? At plus or minus 30% a year and a half out. But anyway, there's a lot of million different ways we could take this. We did have the fortunate ability to add another $119 or so to the public portfolio. So let's just take a good opportunity to check that out really quick while we have some time. So let me just double check. Yep. Okay. So this is once again value. The things that we have highest value in the portfolio are at the top. So that's a BPYPN at a 35% total amount of the account. Couple behind, or followed behind Vornado, preferred shares, NEXT, BPYPM, Carnival Cruise, Norwegian, and then slowly coming down on several other things like China, HIMS, Bitcoin, Celsius, ABCL, some like single stock trackers that were kind of.
There's another Chinese ETF we should probably add. I'll talk to you more about it after this pod, and we'll talk about it for tomorrow.
Okay.
Basically that 100 we could put it there. There's another Chinese ETF that I want to consider adding to this.
Very good. How do you think we've done so far year to date?
I don't know, man. What were you last time? 58%. So probably
60, we broke 60 last time.
Yeah. So what are we now? I don't know.
Yeah, we were at 61 last time. This time we're at 62 and a half.
Okay,
so,
good.
I don't know where the hell we keep going up because it seems like we.
It's because we got those dividend payments. It's because we got the dividend.
That's
payments.
what it is. That's right.
We got dividend payments and we got capital appreciation. So
and I spoke too early. I think like when we had got the dividend payments, I think we only got it from like. I don't remember if it was like BP.
We didn't get it from PN. We only got it from PM. And Vornado, I think, is supposed to pay us like I think the next couple of. Did Vornado's already come in?
I think it did. Let me double check.
Yeah. So this is the thing about investing. You always are gonna, when it comes to fixed income, if you buy something that's fixed income, you're gonna get that fixed income. But then if you buy it at a discount, you're also gonna get capital appreciation on top of it. So, that's why you look at BPYPM and it says, "Oh, you're up 33%." Like, yes, but we also got another almost 9% in interest payments. Because we were able to buy it at such a big discount. So, and the same thing with BPYPM.
I saw some people in the chat earlier specifically talking about, is it still okay to buy some of these preferred shares? What are your thoughts now that we're starting to see some iffiness on the 10-year? What's your thoughts?
I probably wouldn't. I'd just hold on to the positions that I have. There's not, in my opinion, there's just not a lot of capital appreciation left, especially if we get a 3% federal funds rate long term. So BPYPN, I don't think is going to appreciate very significantly. I don't think that Vornado is going to appreciate significantly. So maybe we can trim that a little bit because we do have an outsized position, and I don't want to sit on locked away capital when there's actually other opportunities out there. So I think Vornado we can scale back slightly, and same thing with BPYPN, scale back slightly, and move that into either higher yielding assets or things that are more undervalued. And that's something that we'll discuss offline. And,
we can discuss that. I'm with you. Like, I think when I was thinking that the 10-year was going to head to 3, like maybe high 2s, I could understand why these would get refinanced. But right now, I mean, these are probably about what they would refinance and get. Yeah, they're fair value. So that's why you're not seeing these go screaming to par value, because it's like, okay, well, I don't know. Let me think. I mean, do you think let's play the hypothetical situation. Right now, the sentiment is 25 basis point cut in November, December. And I would say that kind of feels right. But what if something
Matt, short term, no one cares anymore. Like, we shouldn't even bother trying to predict whether the Fed is going to cut half a basis point or 25 basis point in November, December, whatever. I think the point that we need to figure out is, what is the neutral level that the Fed is going to stop? Are they going to go all the way down to 2% on the federal funds?
Well,
rate?
that's what I'm referring to, right? Because right now the sentiment is, this is why the 10-year is increasing right now, is because people are saying, oh, we don't think they're actually going to go down to the 2.5% like I was thinking, right? They're saying they think that they're going to get to 3% and probably hold off, which would mean that these are probably fair valued. If not, maybe by the time you get to that point, maybe they'll refinance and actually buy these back, right? But for right now, it doesn't make sense because you're not there yet. But that's my thought process is if you're signaling quarter point cuts in December, November, that to me means you still think that we're going to end up at low threes on the 10-year, versus if you're cutting at half a percentage point, the trajectory probably is more aggressive, and meaning that you're going to go 2.5% on the 10-year. Maybe the high twos on the 10-year, which would have a completely different outcome on if this is going to do well for the latter half, or not latter half, but the remaining, I guess, of the next 3 to 4 months. And I might be thinking too much into it, and it might be chasing pennies, but it's always, I don't know. I'm not good at these interest rate things, right? I predicted too late and too long for them to kind of come up. And I anticipated they would cut. I did think that they would wait until 2025 to cut. So I'm about right with that. But I don't know. I don't know if they're going to go faster or slower, knowing that in the past, we normally cut too fast. And it's normally based off of a recession or something of the like. This
is sad, but we're going to have to be data dependent, man. It's the saddest thing to say, but it's the truth.
Over here.
We just have to be data dependent. If the data says we need to be a little bit more, chilling, we have to chill a little bit. So, yeah.
Interesting.
So Midwest Cannabis is saying the neutral rate will be 3%. Look, I hope the neutral rate is 3%. That means that we've got a healthy economy. Everything is working okay, which means the 10 years should be between 4.5, maybe, like 4.5, like somewhere between 4 and 4.5. That means that mortgage rates will end up being 5.5 to 6%. Corporate double, I would say triple B debt will probably be somewhere around there. Maybe a little bit higher, like 7%, in which case now you're going to see like high yielding debt probably hover in the 9s. So it's like, it's just 3% is not the new normal I was expecting. I thought we would get a wave of deflation in the second half of the what is that thing called? The 2020s, but you never know. I mean, it still could happen, by the way. New data could come out. Real estate is still coming down around me, but I'm also seeing like the number of people. Have you noticed this, man? How do these people fucking afford these mortgages? Some of these people, man.
Honestly, man, I've been thinking about this a lot because I have a buddy, 2 friends that just bought $1 million house, and I'm not saying they can't afford it, but I'm like, I know for a fact that a lot of the people that I talk to don't actually have any money invested. Like, their thought of an investment is like, I'll throw $5,000 at it. My thought of like an investment is like 50 grand or nothing, right? Like that's where I'm at right now. And so like, they always talk to me. They're like, I can't believe how, because I mean, I talk to them. I'm not going to hide, and like I got some money, right? But I could buy this house that I'm sitting in a couple times over and not even really feel it. But they're over there, like they don't have any money to fall back on. So I think a lot of it is people just straight up just put a lot of their money into their houses, and they don't actually invest. I mean, they might do their 401ks, but they don't actually have money to throw around. And I try to talk people out of that all the time. I'm like, dude, I get it. A 401k is great. But I'm like, at the same time, it's like it gives you no flexibility. What if you want to start a franchise? What if you want to start a business? What if you want to go into real estate? I'm like, and then you get all these fund managers being like, there's the rule 72T. And I'm like, all right, my guy, I don't want to have to take out, to get my 400 grand. I don't want to have to take out 40 grand over the course of 10 years. Give me my fucking 400 grand right now so I can buy this and start this business. Right. Like, so I see the opposite. So it's like, I agree. Invest up to the match. Always fill out a Roth IRA. I believe in that. Don't unabsurdly like lock up your money till you're 60 years old. It just doesn't make sense.
This is going to sound bad, but so basically, I've been looking for houses, right? And I want to live in like a nice area. So yeah. I've been looking at some nice house in a nice area. And it's funny because I look at the sales price in 2019 and it was a certain amount. And certain people are like, literally, they're asking for almost double what it was in 2019. So it's not even reasonable to ask for that. But what's interesting is they're actually getting it. So interest rates are much higher than they were in 2019. And there's actually still people buying. So my question is, either we're just having a very healthy economy, or something is going on in the background that's a little bit nefarious. I think it's
do you live in an area where a lot of people are moving to, though?
Not really. I'd say the population's been pretty flat. I think, okay, so this is what I have noticed. The areas that are not good, those are not like appreciating at all, and they're actually going down. The areas that are desirable, they're going up, and they're going up a lot. So as an example, like if you're in Atlanta, no one is trying to live in College Park. Okay, so if you go to College Park, you can find something cheap. Like just, that's not something that, like if you go back to 2019, you'll find values that are 2019 and probably even a discount. But if you're looking at, let's say, East Cobb, which is like more like the higher, basically wealthier suburb, you're seeing prices that are just absolutely crazy. And the thing is, they're just keep going up. So it lends me to believe that the level of income equality is growing significantly, So I think that's what's happening, where the good areas are getting bid up significantly and the bad areas are going down. Usually, you usually have some normalization in that, but it's not. So, I think what it is people are doing well. And so the people that are doing well are moving into like better areas, and it just keeps going on and on and on. So,
yeah, I think to me, what I've recognized is a lot of people were bidding up vacation areas very heavily. And I think a lot of that was due to the fact that you could do more remote working. And so Florida took a lot of advantage of that because Florida has better weather year round most of the time. And then places like North Carolina, like the Outer Banks, that's a place that we've been looking at, that got bid up really heavy over the, during the pandemic timeframe. I think a lot of people were like, oh, you could live there, right? It's not just like it's a little bit more of a laid back town. It's not like a normal beach town. It's not like you're there for the boardwalk and stuff like that. Yeah, they have one, but it's not like New Jersey where it's very commercialized, if that makes sense. So a lot of people were buying up that. I'm seeing real estate prices in North Carolina come down pretty aggressively. And it's actually making me happy. And I think a lot of that is because there was a lot more Airbnb year-round movements. And so during the peak season, of course, you're always going to get those renters in some of those vacation areas. But I think in 2020, 2021, you had more year round because people were remote working. And they were like, let's just go work from North Carolina for forever. And, you had some people luck out. I have a coworker who was in his kind of retirement age, and he did that during the pandemic, and he actually ended up retiring and moving there. And I see a lot of people starting to kind of plan those sorts of things out. But there's probably the 4 out of 5 that are in the opposite, which is they tested it out and boom, they had to come back to work here in Houston, and they didn't get to live out their dream. A lot of people ended up getting laid off. I know that, unfortunately they couldn't. They were like, hey, you told me I could work remote. I'm working remote. And they said, sorry, we changed our plans. And so I see a lot of that in a lot of these vacation towns. Here in Houston, I think for me, what I'm recognizing more so is I am seeing prices come down, but I think it's more of a shot in the arm of realism, not necessarily the fact that the prices are coming down. in terms of like really aggressively. There are some homes that I think people were like, hey, I bought this in 2021. I assume I can get a 20% year over year like growth on the performance of the house. And I think they're coming to realize you can't, right? So they're either starting to price it at slightly above what they paid in 2020, 2021, or declining it slightly. So it's not like it's taking a 30% pay cut or anything like that.
You know, the one thing I want to just highlight, there's everyone keeps this news that comes out. There's a housing shortage. There's a housing shortage. There is no housing shortage. Let me just very, very clearly put it out there. There is no housing shortage. Okay. There is I want to live in a certain area and there are not enough houses in that area. Yes, there is a shortage, but there is no housing shortage overall. Like, go to Detroit. You can find a ton of houses that are within your price range in Detroit, but no one wants to live in Detroit, right? No one wants to live in certain areas. So once again, there is no housing shortage. There is a shortage on where people want to live. You know, people don't want to live in certain areas where there are houses. That's just the end of it, you know? So a lot of these Gen Z and millennials, when they come up, they're like, there's a housing shortage. I'm like, no, there is I want to live in city center in an urbanized area so I can get my macchiato with a 2-minute walk. Yes, there's not a lot of places around there. But if you are willing to move out, there's tons of places. Especially if you have a mobile career, like, bro, if you're a barista at Starbucks and you're living in like New York City, bro, you need to move. Just get that in your head. You'll never get to a point in life where you're actually saving any real money and equity. All you're going to be doing is just paying for someone else's bills. And it's one of this, I've seen this happen to so many people. It's like financial suicide, man. Like, they'll spend 15 years not saving a dollar because why? They want to live in a city. You know, they want to enjoy the benefits of living in a city. Like, no, like, move the hell out. Find a nice place in a nice part of the country where your jobs and your skills are worth it, but then also the cost of living makes sense. You know, like, I see this all over the place. So normally this is how logical people think, right? Like, people think with logic. Like, if my rent is $2,500 and I make $2,200 and I have to borrow $300 every month, I'm going to become insolvent within like a very short period of time. People don't think that way. They're like, well, I could just put some extra money on the credit card and then, I'll pay this. And then eventually, like, someone will forgive my student loans. And it's like, no, dude, that's not how it is. You have to live within your means. And then also, not only do you have to live within your means, if you want to really build wealth, you have to live below your means, And I think that's the point that one of the reasons why Matt has done really, really well in his life. I've done well in my life and investing. But the reason is we don't live within our means. We live below our means. I'm sure Matt right now could just sell everything he has, live in a $2 million house, or a condo overlooking the city and say, look at me. I'm the smartest guy on the planet. Like, look at my condo. I feel superior. But then you're also committing financial suicide because all your money is being basically dragged into that property instead of actually saving any additional money and putting that towards the future, right? And what's funny is if you do this stuff early, like the first 10 years of your life, you will be saving 30 years of pain in the back end.
Yeah.
But
I can take like you said, I could take my foot off the gas, get normal returns. I'm actually kind of curious because I'm 33. What should I calculate out to? Like 53? Let's just say the next 20 years if I were to get where I'm at right now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. It's a nice number. That's not me contributing any more money. 7%.
Yeah.
It's almost, do you remember the number I was telling you about the other day? It's like a little bit shy of that.
I think
that's at 53 years old. And I'm like, okay.
I think it
gives me some thoughts.
Yeah. I think that guy Indoor Noob put up a good thing. So click on that for a second.
Which one?
The one that's Indoor Noob. That's right there. Migration. migration is a prerequisite for finding fortune. From pilgrims to Israelis, throw a dart at human history timeline, and migration was necessary for finding opportunity. That's right. You have to move where the opportunities are, and basically build your fortune there. So
Yeah. But it just goes to show you, man. I mean, I think a lot of people over science it. It's crazy to me how people want results without putting in any effort. Like they'll listen to some, like it's insane. And I don't know the answer, because at one point I was the same. I would just look at a stock and just be like, okay, cool, let me gamble and hope I was right. Just because I didn't know any better. I didn't have the education. And it really hasn't been until, I slowly started to hone in and really understand exactly what I'm looking for before I started making the right decisions. Like I used to buy penny stocks, for God's sakes, and just be like, yep, this is it. This is what's going to make me the trillionaire. And everybody falls into that because they're so uneducated on everything. They don't know what they don't know. And so it's insane.
The one crutch that always gets me when people say like, but my family lives around here. Okay, how often do you see your family? Like once a month? Bro, just move, bro. Like move and just come visit them once a month,
Yeah, no, that's a good point.
Yeah.
That's a good point. I don't know. I mean, so yeah, I mean, it makes you think, right? Everybody should do their own analysis as to what makes them happy. But what I would say is most people are overspending, and more people could do better by themselves to invest more into the markets. And I think that they would alleviate a lot of concerns towards the latter half of their lives. And I think what ends up happening is this, I see this a lot. People struggle. Then they have kids, and then they struggle even more. And then they can't really do anything until the kids leave the house. They kind of like restrict themselves. And then they're saying, okay, I'm finally 55. Kids are out of the house. I have the next 5 to 6 years to really ramp it up before I can retire. And by the time they're, like they're not having any fun at they're 60 years old because they've just been working. And it's like, to me, if I wanted to, call it quits, I could. And I could live probably the next 20 years and, not even really have to work at all. Right. It's,
bro, I'm done working. Like right now, if I have enough money to the point where I could live a very comfortable life and not work a day in my life, I'm still going to work because I love my job. I love my colleagues, and it's great. I get still derive value from my job. But I also know that if my boss says to me, hey, Chris, I'm going to need you to work some overtime, and I have a pre-existing thing or engagement, I can very comfortably tell my boss, I'm sorry. No, I'm good. Sorry. And I think that's the key, that mental energy, that freedom that you get from not having to be like chasing after the dollars is probably the biggest like stress reliever on the planet. I mean, how many divorces end because of like money? Like they had marriages end in a divorce because of money. So the thing is, don't put yourself in a position where you're going to like set yourself up to struggle. So like I said, I have a friend who's an accountant and his wife's nurse, and they bought a townhouse. It was really nice. And they had like a really great mortgage. I mean, it was like less than 3%, but then they got a dog, and then they were like, well, the dog needs a place to run, so let's buy a house.
Yeah.
And the thing is, they bought at the peak, and then they threw more money at it. And so now they have almost $1 million of debt. And why? Because the dog has a place to run around. Like it's nuts. So the thing is, like, they are one bad year from insolvency. That's the part that hurts, because it's almost like now you're seeing almost $7,000 to $10,000 go out of the door, where before their cost of living was only about 2 at the max. And so they were able to save a lot more for retirement, for all this other stuff, all because the dog needed a place to go running. Like,
See, man, I think I timed this well, and I'm not saying I timed it just for the sake of timing it, but the way I looked at it was, I need a place to live. So I bought this place, and I knew for a fact that I was going to buy at a high interest rate. I was saying, okay, I'm going to buy at a high interest rate. I'm going to put some money into it while I can. I'm going to refinance it. I'm going to refinance it down, probably $500, $600 a month. And to that point, I'm going to be able to make a couple $100 a month if I rented it out. By that point, I'm hoping that interest rates have come down enough where I could probably afford the same house, and it's probably going to be 30, 40% more expensive than this house that I'm living in. And it's probably going to be more of a forever home that I live in. And maybe unless I move back to the Northeast of the US or something like that, but it'll probably be a house that, is more of like a rancher, one floor, decent house with like a decent backyard that I can, barbecue, maybe put a pool in if there isn't one already. Have like a nice little lounging area versus right now, like this is literally just strictly a rental. And that's the way I look at it. And so to me, I think I timed it well because I've been able to get an asset, be able to put some money into it. By the time I'm out of this house, I might have put the total mortgage payments and everything like that. I mean, I don't know about all the mortgage payments, but in terms of equity, it's probably only going to be like 60 grand, 70 grand worth of equity. And it's just going to appreciate. And then I can use it almost as a bank on its own. If I need to make more money on an investment or pull out money to do Airbnbs or whatever. And I don't plan on having like 20 Airbnbs, right? Like I plan on getting to a place where I can get 5 or 6, maybe up to 10 really nice Airbnbs. And then like high grade them. Like you don't need 20 fucking houses. Like you could if you really wanted to. But to me, it's like I just need to get 10 net houses and then I can consolidate them, even shrink down to 6, 7, or 8 and make a crap ton of money. If you find the right houses, man, you could be making 50, 60 grand on a house. If you do it well. Like the house that we bought in May, I'm starting to see small little things where I'm like, we just spent 4 or 5 grand on furniture and it's going to give us another 3 places to sleep in that house. And that's going to be able to raise us another $25 to $50 a night in the summer. And if that rents out for all, 90 days during the summer, you think about it, it's another 4 or 5 grand every year. The value of that house is going to be fucking huge, right? It's like, anyway, I don't need to go down that tangent, but curious to see what happens, man. But I do think that there's going to be some pullbacks. And every time I've been in a pullback, I've made a shit ton of money. 2022, 2020.
The thing is, you just have to be in the market. You just have to stay invested in the market, have some money reserved, waiting for a good deal to come up. And it's just there was this really cool lecture that I saw on Twitter. Let me see if I can find it.
Find it.
Because if I find it, it'll hold on one second.
For any of you guys that are just joining, the 154 of you guys, I just put in the description our my Twitch if people want to ever watch over there. I'm trying to grow it just in case something ever happens to us on YouTube. Just another avenue for me to potentially make a little money. And I know there's another group of folks and another audience on Twitch, and that's all we're doing this for, right? Is to help everybody out and make everybody some money if they so choose. So please, if you have a Twitch, it would be a nice favor for you to go over and subscribe on
Let me see
Twitch.
if I can find it, man. Damn it. I can't find it right this sec. Oh, I found it. Hold on one second. Here we go. So this is probably one of the best videos that anyone could watch on risk, right? And how how you basically let me just show it to you. Once we watch it, we can dissect it together. Can y'all talk about Celsius? I'll talk about it very quickly. Don't touch Celsius. Celsius on a downward trend. You got to wait until the data turns around. There's consolidation. I know tons of people that have been catching falling knives since the 60s, 50s, 40s, 30s. Now it's almost in the 20s again. Do not touch it. Just chill. Wait till the data proves. Like there's bigger chance of you losing money if you're just doing it blind because, it was 40 yesterday, so today 30 is cheap. No, wait until the data tells you that 30 is cheap. That's all I'm going to say about that.
Yep. I have like a very small 100, 200 share position because if it does turn around, I plan on loading into it, but I think you're going to have to wait for 3Q to have at least stabilize. And once it does, then I feel like you can get a little bit of bump off it. Is it going to go back to 100? That's not why I would invest in it. If you think it's going to go back to 100, I would say in the short term, I would just say stay away. I doubt that it would have that sort of return. I think that was exuberant. But if you think that it could be something that's slow and steady over the course of time, gets back to the $60-$70 range, then might be more.
And you got to know that this is a consumer packaged goods business. Okay, when consumer packaged goods business, they live and die based on the consumer demand trends. So, have you ever heard of like all these no-name brands have basically come and gone, and they've never made a single, because consumers opted not to go with them. So Celsius had a lot of weight behind them initially, but a lot of that weight is coming off, and there's alternatives coming out that people are finding more attractive. So the data is all right there. It's right in front of everyone. So, just wait for the data to flip around before you start to say that, hey, this is cheap based on a stock price. No, find, if it's a consumer packaged good, find what the consumer is doing. Are they purchasing more of it, or are they purchasing less? If they're purchasing less and the growth is less, then factor that into the calculations. So, all right, let's watch this real quick.
It means equal risk weighting rather than.
I've watched this. This is great.
Assets. So risk parity really means equal risk weighting rather than equal a market exposure. And then the further step he took was, he said, okay, so this actually, is the equal risk. So you have lower return and the lower risk, a lower standard deviation. But sometimes people really want a higher return, right? How do you satisfy both? Higher return and lower risk. Is there a free lunch? So he was thinking, right? So there is actually. So not quite free, but it's the closest thing. You probably heard this phrase many times. The closest thing in investment of free lunch is diversification. Okay, and so he's using a leverage here as well. So, but let me talk about a bit more about diversification. Give you a couple more examples. Okay, that phrase about the free lunch and the diversification was actually from is that from Markowitz, or people gave him that term? Okay, but anyway, so let me give you another simple example. Okay, so let's consider two assets, A and B. In year one, A goes up to basically doubles, and year two goes down 50%. So where does it end up? So started with 100%, it goes up to 200%, then you go down 50% on the new base. So returns nothing, right? It comes back. So asset B in year one loses 50%, then doubles, up 100% in the year two. So asset B, it basically goes down to 50%, and it goes back up to 100%. So that's when you look at them independently. But what if you had a 50-50 weight of the two assets? So someone is quick on math can tell me what does it change? So A goes up like that, B goes down like that. Now you have a 50-50, A and B. So let's look at magic. So in year one, A, you have only 50%. So it goes up 100%. So that's up 50% on the total basis. B, you also weight 50%, but it goes down 50%. So you have lost 25%. So at the end of the year one, you actually, so this is the combined 50-50 portfolio, year one and year two. So you started with 100. You're up to 1.25 at this point. Okay, so at the end of year one, you rebalance, right? So you have to come back to 50-50. So what do? So this becomes 75, right? So you no longer have the 50-50 weight equal. So you have to sell A to come back to 50 and use the money to buy B. So you have a new 50-50% weight asset. Again, you can figure out the math. But what happens in the following year, when you have this move, this comes back 50%, this goes up 100%. You return another 25% positively without volatility. So you have a straight line. You can keep, so this 2 year so that's so-called diversification benefit.
What people didn't understand about that, because I know it can sometimes get a little complicated, but one of the reasons why we have a 60% return in our portfolio right now is because we rebalance. Okay. If we didn't rebalance, we wouldn't have a 60% return. Can you show our screen? Can you show the screen, Matt, real quick?
Which one?
Our portfolio.
Oh, okay. I was like,
Yeah.
what screen? Yeah, we move around a lot.
See, one of the things is when you get an opportunity where you can diversify a little bit and take some of your winnings and move it into things that are a lot more opportunistic, that is the benefit that you're going to get. Now, here's the thing. Sometimes that works in your favor and other times it doesn't, but I found it works a lot better. So when it comes to like even my personal portfolio, I'm up significantly in my portfolio because I didn't just say, you know what, I'm going to buy and hold forever. Like, no, like I know that there are times where valuation gets a little crazy and that I need to diversify my position and rebalance myself so that I don't let that one position become a core part of my position. In which case now, if that one class underperforms, the rest of my portfolio is going to underperform as well. You know, so I know some people are like, oh, buy and hold forever. Congratulations if you think that that's okay. But for a portfolio manager and someone who's managing a portfolio and being a little bit active, when you see things get overvalued, like really significantly overvalued, that's when you have to trim. Not a lot. You don't sell everything. You can trim a little bit, take that money, deploy it into something else that has opportunity. And basically the opportunity will compound in the next rebalancing. You know, that's why if you look at all these portfolios, they rebalance constantly because it takes the volatility out so that you don't have a 50% drawdown. So like right now, if you're in Palantir and you've made a 5x return and you know the valuation's high, you don't have to sell out of it completely, but hey, taking some off the table, investing in something else that might give you a good return will help mitigate some of that volatility in your portfolio so that if you do get a 30% drawdown, your entire position isn't getting drawn down 30%, you know? So
Yeah,
it is what it is.
For example, like, let me just read out. We took Celsius. We were buying Celsius in between 50 to 63. That was kind of our range when we were buying it. We were buying 1 or 2 shares here and there. And this is when the portfolio was a lot smaller, by the way. But overall, we probably put in close to $500 or so overall for that entire purchase, and we netted $300 in gains. Same thing with Carnival Cruise. So we bought, I forget how many shares total we bought at Carnival, but we monetized some of that, right? I think we put in. We
rebalanced. We rebalanced the position. You know?
So there's that. Where else have we done really well? Hims, we rebalanced a little bit as well. So we were buying Hims at $13. We monetized some of that at 21. Norwegian Cruise, we did the same. We bought some at 10. We monetized. Holy shit. No, sorry, I read that wrong. 16. We bought at 16 some. We monetized at $20. So, I mean, that's a small 20, 30% there. Tellurian, we were buying at like 60 cents a share. We monetized anywhere between 80 to 95 cents. So that's a 50% growth there. Another good one that we did was TQQQ overall throughout the year. We were buying anywhere between 36 when I was telling Chris he should buy full port, and he never listened to me. And we were buying all the way up to $57, and we sold the whole lot of it at $68. So we ended up making $250 on that. YCL, which one was YCL? That's the yen trade. We ended up making a couple, like 20, $30 on that. So a lot of these are just small little onesie twosies. TMF, we were buying at 51. We sold at 58. Really the only ones that outliers that are in the opposite direction is like Snowflake. DPST, we lost some on. That was really one of our only. Yeah, those are the only losing trades that we've had. It's like DPST and what was the other one I just said? Let me see. TMF. No, TNA. I'm sorry. We made money on TMF. TNA is another one that we we were stuck in the beginning of August when the yen carry trade was happening. So I mean, a lot of great trades that we've made. Really good success rate, but a lot of them are $40 here, $20 there. So cool. You're on mute, Mr. Patel.
So the general rule that some people are saying, don't cut your flowers to water the weeds. Absolutely. I think that's a great saying, but you also have to distinguish what is a good flower and what is actually a weed, right? So that's the thing. Like if you look at this is where I guess everyone's investing styles are going to be different. You know, for us, I think we've done well enough to the point where we can at least say that, hey, we know somewhat what we're doing. So hopefully this is one of those things that keeps us, we're acting more like a traditional fund rather than an individual investor who's just like, okay, this is my thesis and I'm just going to live with it. So we'll see what happens.
The only thing I'll say about next decade is some guy keeps asking about it, which is fine. I appreciate that. I think it's a good opportunity, man. I think a lot of people are starting to see some of the bogusness and the bias that was kind of going on with respect to the DC Circuit ruling, and I don't think they're going to let it lie lightly. They're continuing to construct. You got senators involved now, and governors involved, and other nations involved at this point, technically.
For what? Liquid LNG?
Yeah, next decade.
Yeah. All right. Yeah.
So
we'll talk about it more next time. I got to head out. So
yeah, me as well. But yep, you guys rock. I'll talk to you guys next time. Hopefully you guys got something out of it. If you guys haven't subscribed already, the 150 of you that have been sticking around for the past 20-30 minutes, please go ahead and do so. We will catch you next time.